tariffs, 25% on Canada and 25% on Mexico, and that'll start. So they're going to have a tariff. So what they have to do is build their car plants, frankly, and other things in the United States.
Is it time to sell? Is this the right time to get out? With the stock market experiencing dramatic swings, many investors are panicking, fearing the worst. The headlines scream disaster, warning of an impending crash. But is the situation really as dire as it seems? The truth is, the market operates in cycles and downturns are inevitable. However, history shows that those who stay informed and make strategic moves can turn uncertainty into opportunity. Instead of reacting emotionally, let's break down what's really happening, why it's happening, what Trump means, and how you can navigate these turbulent times to come out ahead. Is fear driving the market? Right now, panic is spreading like wildfire. Investors are scrambling to make sense of sudden drops, wondering if they should cut their losses before things get worse. But before making any rash decisions, it's important to understand what's truly fueling this uncertainty. At the heart of the panic is uncertainty, the single biggest driver of volatility. When the market slings wildly, it's not just numbers on a screen. It reflects the collective emotions of millions of investors. Fear and doubt creep in, pushing people to sell in a rush to protect their wealth. But historically, acting on fear has rarely led to smart financial decisions. What's causing the current uncertainty? Several key factors are at play. Economic policies, global conflicts, inflation concerns, and political instability all contribute to market fluctuations. When investors lack confidence in what's coming next, they react emotionally, often making the situation worse. The media plays a major role in amplifying this fear. Dramatic headlines grab attention, warning of impending crashes and financial collapse. While staying informed is crucial, it's just as important to filter out the noise and focus on facts. Market dips are normal. Every crash in history has eventually been followed by recovery. Another major driver of panic is herd mentality. When people see others selling, they fear missing the chance to exit before further losses. This leads to a chain reaction, driving prices down even further. But successful investors recognize that these downturns can present rare buying opportunities. Understanding the root of market panic is the first step in making better financial decisions. Instead of reacting emotionally, it's time to analyze the bigger picture. What's causing the fear? Is it a temporary correction or a sign of something more serious? With the right mindset and strategy, you can navigate the volatility and even turn it to your advantage. This is exactly why you are watching this video. If you liked it this far, please subscribe our channel for support. Well, what if I told you that a single decision could send shockwaves through the global economy? What if that decision affected your job, your savings, and even the price of your next meal? Would you pay closer attention? Yes, this is exactly what's happening with Trump's trade war. And before you react, I urge you to watch this part carefully, maybe even rewind, because what we're about to break down is crucial. Let's start with the basics. What is a trade war? In simple terms, it's when countries slap tariffs, taxes on each other's imports. The goal? To protect domestic industries. But in reality, it often sparks retaliation, disrupts supply chains, and drives prices up for everyone. Now, here's where it gets serious. Trump has long positioned himself as a master negotiator, but his aggressive approach to trade policies has left the market on edge. His tariffs on key imports, especially from China and Canada, have triggered economic uncertainty. You might think that doesn't affect me, but it actually does. Higher tariffs mean higher costs for businesses, and guess who ends up paying the price? You. Everyday products, cars, appliances, even groceries become more expensive. Companies struggle with rising costs, leading to job cuts or stagnant wages. And investors? They panic, driving the stock market into turmoil. Still not convinced? Okay, then let's rewind to history. The Smoot-Hawley Tariff Act of 1930 had a similar goal: protect American businesses. Instead, it backfired, worsening the Great Depression as global trade collapsed. Now, ask yourself, are we heading down the same path? But here's the twist. Trump's trade war isn't just about economics, it's about power. I mean, countries like China are forming new trade alliances, reducing their dependence on the US. If America isolates itself too much, it risks losing its global economic influence. So, what does this mean for you? It means pay attention. Don't just react, also analyze. If you missed anything, go back and rewatch this section. The effects of this trade war are unfolding right now, and understanding them can help you navigate the storm ahead. Trump's views on NATO and global stability. When a US president openly questions the relevance of NATO, the effects aren't just political. They ripple through global markets, economic strategies, and investor confidence. Donald Trump's repeated criticisms of NATO, particularly his view that the United States should not defend its allies unless they pay their fair share, have raised serious concerns about the future of international stability. And that uncertainty doesn't just stay in the realm of diplomacy, it hits your wallet too. Global markets rely on stability. Investors don't just watch interest rates and earnings reports, they pay attention to world order. When the strength of alliances like NATO is called into question, it sends a signal that the balance of global power could shift. And markets don't like shifts they can't predict. European countries, recognizing the potential shift in US commitment, have started increasing their defense spending and discussing greater military independence. This marks a significant geopolitical shift. Meanwhile, countries like China and Russia see opportunity in this uncertainty. Both are ramping up their global influence, China through trade alliances and economic investments, and Russia through military positioning and energy leverage. The consequences for the economy and markets are tangible. If US support for NATO wanes, it could lead to instability in regions that rely on that alliance. Conflicts or tensions in Europe could disrupt trade and energy supply chains, causing spikes in oil prices and affecting manufacturing and transportation costs. This pressure trickles down to consumers and businesses, raising prices and reducing margins. Moreover, uncertainty in military alliances often results in higher defense spending, diverting funds from other economic growth areas. Investors start pulling back, currencies fluctuate, and risk appetite shrinks. In such times, volatility becomes the norm. When unpredictability rises at a global scale, it's not just a foreign policy issue, it becomes an economic signal. And for investors, that signal is clear. Tread carefully, stay informed, and be ready to adapt. So, a market crash feels like the end of the world, but for the informed investor, it can be the beginning of real wealth building. The key is mindset. While others panic and sell, you need to think long-term, stay calm, and act strategically. First, understand that during a crash, stocks are essentially on sale. Prices drop not always because companies are failing, but because fear takes over. Quality companies with strong fundamentals become undervalued, and that creates rare buying opportunities. When you add these stocks in your portfolio and reduce your cost, it would be the smartest thing to do in such environment. History proves this time and time again. After the 2008 crash, many who continued to invest saw their portfolios double or even triple over the next decade. But before jumping in, make sure your financial foundation is solid. You need an emergency fund in place and high-interest debt paid down. Then, instead of trying to time the bottom, a game even experts rarely win, consider using strategies like dollar cost averaging. By investing a fixed amount regularly, you reduce the risk of buying at the wrong time and smooth out your average purchase price over time. Diversification also becomes critical. Spreading your investments across different asset classes, stocks, real estate, bonds, even precious metals, can help weather the storm and reduce risk. Don't bet everything on one sector or stock. I mean, who carries all their eggs in one basket, right? Most importantly, stay emotionally grounded. I know it's hard, but crashes are temporary, but the decisions made during them can have permanent effects. Selling in a panic walks in your losses, but staying invested, adjusting your strategy smartly, and continuing to contribute can put you miles ahead once the market rebounds. The market always recovers. The question isn't if it's when, And those who prepare, stay focused, and act wisely during the downturn are often the ones who come out wealthier on the other side. Let's face it, the market will always move. Sometimes up, sometimes down, and sometimes it'll feel like it's in free fall. But here's the truth. Market crashes are not the end of your financial journey, they're part of it. Building wealth isn't about perfectly predicting the top or bottom. It's about discipline, perspective, and strategy. When fear takes over the market, most people react emotionally. They sell low, lock in losses, and wait too long to get back in. But successful investors? They do the opposite. They stay calm, they stay focused, and most importantly, they stay invested. Yes, the headlines are loud. Yes, the numbers can be scary. But you don't build lasting wealth by following the noise. You build it by understanding the bigger picture, planning ahead, and trusting the process. That means having a diversified portfolio. It means sticking to your investment plan even when things look uncertain. It means remembering that every single crash in history has been followed by a recovery. If you've made it this far, you're already ahead of most investors. You're asking the right questions. You're not just reacting, you're learning. And that's the mindset that leads to long-term success. Keep your emotions in check, your strategy clear, and your eyes on your long-term goals. Because wealth isn't built in moments of calm, it's built in how you respond to chaos. If you found this video helpful, hit the like button, subscribe, and share it with someone who's stressing about the market. Stay smart, stay steady, and we'll see you in the next one.